Here is a striking fact for currency watchers on this Sunday, the 19th of July, 2026. The Singapore dollar has been pinned near its recent lows against the US dollar, and analysts at United Overseas Bank, one of Singapore's most influential financial institutions, say that pattern is showing no sign of breaking. The SGD/USD pair has been locked in a tight, well-defined range, with the Singapore dollar unable to push meaningfully higher and equally failing to collapse lower. This is not a one-day blip. It is a sustained, structured consolidation that UOB strategists have flagged consistently for weeks. Whether you trade currencies, run a business with cross-border exposure, or simply send money between Singapore and the United States, this range-bound environment has direct and immediate consequences for you. United Overseas Bank's currency strategists have not wavered in their assessment. As early as the 7th of June, 2026, UOB reported that the Singapore dollar was in range-bound consolidation against the US dollar. By the 2nd of July, the bank reiterated the SGD was holding near recent lows with a range bias still intact. And as recently as the 17th of July, just 2 days before today, UOB's position remained exactly the same, range trade near recent lows, with no clear directional catalyst in sight. This consistency across 6 weeks of analysis is significant. It tells us the underlying forces driving SGD weakness are structural, not fleeting. Chief among those forces is the sustained strength of the US dollar on global markets, itself underpinned by Federal Reserve policy expectations and the relative resilience of the American economy compared to many Asian peers. When the world's reserve currency is strong, commodity-dependent and trade-oriented economies like Singapore feel the gravitational pull. A weaker Singapore dollar against the US dollar has tangible consequences today. For Singaporean importers paying suppliers in USD, whether that is electronics from the United States, commodities priced in dollars, or global software licenses, a softer SGD means higher costs at the point of conversion. Those costs often get passed downstream to consumers. For exporters, though, the picture is somewhat more favorable. A lower SGD makes Singaporean goods and services marginally cheaper for overseas buyers, providing a thin competitive advantage in price-sensitive sectors. On the trading floor, the range-bound environment is a double-edged sword. Momentum traders seeking a directional breakout will find this market frustrating. There simply is no trend to ride right now. But traders deploying option strategies or range trading setups can find genuine opportunity in a market where the boundaries are clearly defined, and UOB's analysis provides an authoritative framework for where price is likely to stay. UOB's outlook suggests the range trade dynamic is likely to persist in the near term, but it will not last forever. The two most significant catalysts that could shift the SGD are, first, a surprise signal from the US Federal Reserve. Any shift in the language around interest rate cuts or hikes would immediately reprice the US dollar and ripple through SGD/USD. Second, and arguably more relevant domestically, is any change in stance from the Monetary Authority of Singapore. Unlike most central banks, the MAS does not set interest rates. Instead, it manages monetary policy through the Singapore dollar's exchange rate itself, specifically by adjusting the slope, width, and center of a trading band. Any MAS policy shift would be the single most powerful domestic catalyst for a breakout. Traders should also monitor Singapore's upcoming trade and inflation data, as strong or weak readings can influence MAS expectations and therefore SGD sentiment. To bring everything together clearly, as of today, the 19th of July, 2026, the Singapore dollar remains firmly near its recent lows against the US dollar, locked in a persistent range that United Overseas Bank has flagged consistently for the past 6 weeks. The forces keeping it there, US dollar strength and the absence of a domestic policy shift from the MAS, remain intact. Do not expect a dramatic directional move without a concrete macro trigger. If you are a business, now is the time to review your hedging strategy and ensure you are not caught exposed if the range eventually breaks to the downside. If you are a trader, use the range boundaries as your framework and stay alert for Federal Reserve or MAS signals. Knowledge of where you are in a range is not a limitation, it is your edge. Subscribe now to stay ahead of the next move in Singapore dollar and global currency markets.